Yeah, I mean, I spent my career, as a 2 and 20 manager, and increasingly recognize that, 2 and 20 managers and 2 and 20 strategies, they're pretty good for the manager and pretty bad for the investor. And the primary reason why that is because the fees are too high. And in addition, for taxable investors, they're almost always put in structures, just going back to our conversation before, they're always put in structures that are tax inefficient. So LP structures, which are taxed at ordinary income. And so our thought was, could we use technology to understand how how managers were positioned, the most sophisticated managers in the world. If you could infer how they were positioned, you could then take that understanding, translate it into long and short positions, and package it in much more tax efficient structures that are available to every investor, in particular in the ETF structure. And so that's really what I've been focused on over the last couple of years, is basically challenging the hedge fund industry, the venture capital industry, the private equity industry, in terms of using technology to basically replicate how their returns are coming out, and then making that available to everyone, much more cheaply, much more tax efficiently than what exists today.
Kevin, do you have a question for Bob?
I do, Bob. So as we try and democratize alternative investments or hedge funds and bring them to the masses, how much gets diluted or watered down when we try and fit everything that a hedge fund generally tries to employ into a 40 Act ETF, as you just mentioned there? Can the investor still experience the same type of returns, the same type of risk mitigation techniques within an ETF that they could if they just invested in the hedge fund directly themselves?
Yeah, it's a good question, and a common question when people are thinking about essentially that trade-off between a replication versus investing directly in the funds. And when you think about that question, one of the things that you can do, you can't capture all hedge fund strategies in an ETF wrapper, particularly high frequency, liquidity providing strategies. So Rentec, not in an ETF. But if you think about it, the hedge fund industry is $5 trillion of assets. And if that's the case, then basically hedge fund managers in aggregate are taking directional positions in the 60 or 70 most liquid markets in the world. Right. And those directional positions can be implemented using highly liquid securities, futures contracts, exchange traded, index funds, things like that. And so the reality is you can get, let's say, 90% as good in terms of the quality of the views as if you invested in all the hedge funds, which you can't do practically, right? In an ETF wrapper. But the key thing to remember is if you can do that, but you pay a quarter of the taxes, a quarter of the fees and half the taxes, then no investor cares about the gross of fees returns of any investment strategy. No one cares because they don't see that. The manager sees that, but they don't see that. What they care about is net of fees, net of taxes, net of advisory fees, right? That's what they care about. And so what we're doing is we're creating something that's a pretty darn good representation of those strategies. And then when you add in those other elements, those other saving elements, in many cases for investors, you have something like a 90% probability of outperforming, an individual manager selection over a short time frame, given the fee savings and the tax savings.
Let me ask you this, because the world of investing right now, I've been in AI now almost 2 years. And at the first AI firm I was at, we were very heavy into data chunking and indexing in order to allow people like you to ask a natural language query and get almost immediate answers in easy to understand language along with the sourcing. But what I learned in that process was the answer is only good as the database from which the secondary financial tool is allowed to access. So where do you see this heading? Because I'm hearing people say that AI will put individuals like you or your businesses out of business. And my experience is that, no, it's a tool for your businesses. I don't think it's going to put anyone out of business just yet.
Well, I think when you're thinking about AI, there's sort of a challenge with a lot of investing related activities related to AI, which is, AI is particularly good at high quantity inference. So, for instance, take all the written words in the English language and use that in order to, ever essentially, and use that to predict what the next word is in a sequence. Okay, well, that's a huge volume of data to create inference on. Or how do you learn how to pick out pictures of cats? You look at literally billions of cat pictures, and then you learn, right? When you think about financial markets, the reality is that there's been like 8 cycles in the last 100 years. Well, 8 data points essentially is not particularly useful in terms of trying to draw AI inference. And even if you start to talk about, let's say, the hourly or minute performance of every stock in the S&P 500 in the post-war era, that's still a tiny sample size. And so what that highlights is you need people, frankly, who are not so reliant on data inference to build investment strategies and manage investment strategies, and frankly, visualize the impossible, you know what I mean, in terms of how things could play out in order to successfully run money. And so these strategies, these AI, I call them more like techniques. And if you've been in this business for long enough, particularly as a systematic investor, you see these AI strategies today, and they just are just another tool along the path of different analysis tools. But at its core, the only way to manage money successfully is you have to have a person with deep expertise, deep understanding, bringing their common sense framework to thinking about how the world's going to work and applying that in a way that's rigorous, but also imaginative.
I got as a favor to Julia LaRoche, who is a buddy of mine. We work together at Yahoo Finance, and she has a very successful podcast, the Julia LaRoche Show. You should go to YouTube. You should subscribe. You were just on it in February, and she gave me permission to use a soundbite from that podcast because you called out, you called something, and we're living it today, and it had to do with expectations for 2025. And here is what you said to Julia.
If anything, the policy mix, both from the Fed and from the new administration, look less positive than I think many people expected. And so when I see that, that combination of dynamics is teeing up for a likely growth disappointment through the course of 2025. And we're probably going to see a reversal of that environment where, the last couple of years, stocks radically outperforming bonds. Now, we're likely to see a flip of that as we go through 25.
Bob, do you see a world in which AI could have made that kind of statement within the next year, or is it way off?
Oh, I think that sort of level of inference, which I know seems so obvious. I mean, it certainly seems obvious sitting here today relative to where we were at the beginning of the year, because that's what's happened. I think it wasn't obvious to 95% of forecasters of the S&P 500 at the end of last year. Like that's not an easy thing to draw that inference, and particularly thinking about it in the context of there's just like not a lot of sample size of that. Like that required an understanding, some data in terms of expectations and understanding that, but required imagining a world of what could play out and all the linkages that it could occur. And I think we're very far away. I mean, I've seen people work on this, try and create, frankly, like macroeconomic models out of AI inference. And you constantly run into, first of all, consensus thinking, which is challenging, right? Because in order to generate alpha in markets, you can't have the consensus thought. You have to have a non-consensus thought. So that's one of the problems, which is inference on the consensus. And number 2 is failure of imagination and just, things that they have not, like, for instance, here's a very simple example. Like, how would you know if you were an AI, what the impact of, the new administration coming in and restricting immigration would be? The sort of immigration restriction that we're seeing transitioning from the previous administration to today is the most radical shift in immigration policy that has existed, in hundreds of years in the United States. Okay. Where's the data? Where's the inference? Where's the conversation about that? How are you going to figure that out? I think that's the challenge that these sorts of processes have if sort of left to their own devices. But what I would say is, I mean, even our approach to infer hedge fund positioning, it is leveraging machine learning techniques that were not available 5 years ago and were not economically viable from a compute perspective 5 years ago. So you could use the tools, but they're just tools. You have to have them guided by people thoughtfully using them in the right way.
Kevin?
Yeah, I think if I could just jump in here real quick, from Bob's example, we started this year looking at historical data and analyzing massive amounts of historical data. That's a very primitive form of AI, if you will. And what we found was that going back to 1950, there had been 9 previous times when the stock market rallied by 20% or more in consecutive years, 2024, of course, being the 10th time. What we found that was comforting was that in 90% of the time, the market was higher the following year. Perhaps what wasn't so rosy was that it was only higher by an average of 3.6%. So that told us maybe we shouldn't be expecting as big of a year in 2025. But our clients don't want to hear that. They want to hear, how can I still outperform in that type of environment? And that's when I think machine learning and artificial intelligence can help us to analyze different periods when these factors are in place to help identify what areas of the market may provide with those alpha opportunities, just as Bob's explaining before.
Bob, where are those opportunities right now? Can you share with us what you might be seeing from the tools you're using?
Yeah, well, I think the biggest thing right now, particularly if you look at professional money managers, hedge fund managers, is this is a time of low conviction, and that's important because in order to generate high quality returns over time, you have to know there are times when you have confidence in your views and times when you don't have confidence in your views.
Right.
And this is a period where very aggressively you should have low confidence in your views. And so, I mean, just look at the tariff situation, right? We went from 25% in the last 6 weeks, we've gone 25% tariffs on Canada and Mexico to 0 to 25 to 0 to 25 on the most important products, right? Like, unless you're somehow in the mind of the fella in the White House, and like, how are you ever going to trade markets based on? Like, it's impossible. It is literally impossible. Anyone who says that they can trade markets in this environment based upon predicting policy or whatever, they don't know what they're talking about. And so that's the biggest thing is it's a low conviction environment. And then I think the second sort of overwhelming thing that we see is that the risk of a set of negative growth policies has yet to be fully priced in to the market. The stock market's down a little bit from peak, down 10% or a little less than that now. But the reality is we're still at the same levels as we were at the election point. And I think the policy mix has turned out to be less pro-business than certainly was hoped for, and less, at least in the short term, pro-growth than was hoped for. And what we're really seeing is a series of negative growth policies in the short term. We can argue whether it makes sense in the long term, but in the short term, it's pretty clear. And that really isn't priced into stocks or the bond market at current levels.